Hello everyone. Today we'll be discussing the role of the central bank and the banker customer relationship. This is a very important topic in banking law and financial regulation as it connects the macro functions of the Reserve Bank of India with a micro trust between banks and their customers. To begin with, the central bank plays a very vital role in maintaining monetary stability and regulating the banking system. In India, the Reserve Bank of India or RBI functions under the RBI Act of 1934 and the Banking Regulation Act of 1949. On the other hand, the banker customer relationship, which forms the foundation of all banking transactions. This relationship is multidimensional. It's not just a debtor creditor relationship but also involves a role such as trustee, beneficiary, and principal agent. In this session, we aim to connect how these two, that is, the central bank's regulatory role and the banker customer trust, sustain financial stability and inclusion. Banking isn't just about money, it's a system which is built on trust and accountability. As the Supreme Court once observed, banks are not merely commercial institutions but trustees of public funds. The Reserve Bank ensures the macroeconomic stability, while at the micro level, the banker customer relationship ensures confidence in daily transactions. Together, they form the backbone of the economy. The Reserve Bank of India was established under the RBI Act of 1934 and began its operations in 1935. It was nationalized in 1949, marking its transformation into a public institution. Today, the RBI performs several crucial functions. It acts as a monetary authority, it formulates and implements monetary policy, manages issuance of currency under Section 22 of the RBI Act, acts as a regulator of banks under the Banking Regulation Act, and functions as a lender of last resort during financial crisis. It also manages India's foreign exchange through the FEMA 1999 and promotes financial inclusion through schemes like Jan Dhan Yojana and the Banking Ombudsman Framework. The judiciary has consistently reinforced the RBI's authority. In Jayantilal N. Mistry versus RBI, the Supreme Court emphasized that RBI must act in the public interest and ensure transparency. In Peerless General Finance versus RBI, the court recognized that RBI's directives carry the force of law. And in ICICI Bank versus official liquidator of APS Star Industries, it was held that RBI is empowered to frame policies in the larger economic interest. These cases affirm that RBI is not just a regulator but the guardian of India's financial stability. Globally, every central bank, be it the Federal Reserve or the European Central Bank or the RBI, all act as the economy's anchor. The RBI manages a monetary policy through the Monetary Policy Committee established under Section 45ZB of the Act. It also acts as the lender of last resort during crisis, which is a principle first discussed by Walter Bagot in 1873. Even during the COVID 19 pandemic, the RBI's long term repo operations injected much needed liquidity into the economy. Further, as a regulatory and supervisory authority, RBI ensures prudential norms, capital adequacy under the Basel III norms, and fair customer service through master circulars and directions. Now, let's turn to the human side of banking, that is, the banker customer relationship. This relationship is at the core of trust in financial dealings. It can take many legal forms. First, that of a debtor creditor relationship, as seen in the case of Foley versus Hill and Joachimson versus Swiss Bank Corporation, where banks owe repayment only upon demand. The second is that of a bailor bailee relationship when customers deposit valuables in locus, as held in the case of Punjab National Bank versus KB Shetty, made banks liable for negligence in locus services. Third, a principal agent relationship as explained in Indian Bank versus Catholic Syrian Bank when banks collect checks or act on behalf of customers. Lastly, there's a fiduciary relationship where banks owe confidentiality to customers as established in Turnier versus National Provincial Bank. In the digital age, this traditional relationship has evolved. With fintech, online banking, and UPI transactions, issues like data privacy and cyber fraud have emerged. the Digital Personal Data Protection Act 2023 now mandates banks to ensure stronger protection for customer data. Financial inclusion initiatives like the Jan Dhan Yojana have also expanded the definition of customer, bringing millions of unbanked individuals into the financial system. RBI's oversight directly influences how banks interact with customers. Under its KYC Master Directions of 2016, identity verification is compulsory to prevent fraud. The Fair Practices Code of 2003 ensures transparent loan procedures, and the Cyber Security Framework of 2016 mandates strong data protection in digital banking. Together, these guidelines ensure that the modern banker customer relationship is not just contractual but also regulated in the public interest. Despite these safeguards, challenges still persist. With digitalization, cyber threats and online scams have risen. Balancing financial inclusion with anti money laundering compliance remains a tightrope walk. Globalization has added another layer with cross border banking and fintech companies. Jurisdictional overlaps often complicate supervision. Finally, cases like ICICI Bank versus Shanti Devi Sharma remind us that banks must uphold ethical conduct and consumer rights at all times. In conclusion, the central bank ensures the macroeconomic stability while the banker customer relationship ensures micro level trust. Together, they form the twin pillars of a sound financial system. As Justice V.R. Krishna Iyer once said, banking is not merely a commercial service but a public trust. In this digital age, maintaining that trust requires strong regulation, ethical banking, and a continuous commitment to transparency and inclusion. Thank you for watching.